Hello, everybody, and welcome to today's Blockworks webinar, Building a Best-in-Breed Surveillance and Compliance Program in Digital Assets. Today's episode is made possible by Eventus. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to today's host, Blockworks reporter Jackie Melinek. Jackie, please go ahead.
Hi. Before we get started, I'd like to give a shout out to today's sponsor, Eventus, for making this possible. Eventus serves some of the world's largest exchanges, including Coinbase, FTX, Gemini, and others as a leading provider of trade surveillance and market risk solutions for the digital asset space. To start, I'd like to do a quick round of introductions. Joe, could you start first?
Sure. Thanks for having us. Joe Schifano from Eventus Systems. I'm the Global Head of Regulatory Affairs. Go around the horn here.
Pelle?
Hi, am glad to be here. I'm Pelle Brændgaard, the CEO of Notabene.
Cool. Esteban?
Hi, everybody. My name is Esteban. I am the CEO of TRM.
And then last but not least, Matthew?
Hi, everyone. I'm Matt Comstock. I'm a shareholder at McGonigle PC. It's a law firm, and I'm in the DC office.
Perfect. To kick off the webinar, I'd like to start with a general question, and then kind of what are some key differences between crypto and traditional finance in terms of risk and market structure, and how does that impact surveillance and compliance efforts?
I'm happy to take a first stab at this. Blockchain is very different. The crypto economy is very different from the traditional financial system in many ways. We're moving from a world where regulated financial intermediaries facilitate most financial activity to a world where anyone can create a blockchain address and transfer funds to anyone anywhere in a totally decentralized way. And at first glance, I think that might strike fear in terms of the ability to manage risk. But blockchain-based transactions actually enable more effective, anti-money laundering, countering CFT and sanctions risk management than traditional transactions. You can think about a few different properties of blockchain transactions. The permanence of the blockchain. You're able to look at kind of the risk profile of any historical transaction. The blockchain's transparent. Historically, financial institutions could only look at the transactions on their platform to understand kind of risk. But today, FIs can step outside the walls of their financial institution and understand risk at a more holistic level. And finally, the data is accessible. Regulators have direct visibility on the transactions. They don't have to wait for this game of telephone through suspicious transaction reports to actually be able to detect where there's financial crime taking place. And so we're seeing that blockchain presents challenges, but there are far more opportunities for more effective risk management and compliance than in the traditional financial system.
Yeah, this is Matt. I'd just like to add that sort of hanging over risk management, surveillance, et cetera, is regulatory uncertainty, right? And that manifests itself in a number of ways. The persons, the individuals, the entities that want to trade and transact in cryptocurrencies and other types of tokens have to contend with the fact that the SEC in particular has not given clear guidance on what constitutes a security and what doesn't constitute a security in the crypto space. And that can play out in a number of ways. If you're an entity, a crypto dealer, an advisor, something along those lines that has customers, you have to contend with that regulatory uncertainty. And for example, if you're providing access, if you're an entity providing access to trading cryptocurrencies and you're doing so through some sort of a liquidity provider, it can be an exchange, it can be a dealer, et cetera, you have to ask yourself, which of those cryptocurrencies should I be allowing my customers to trade? Just because a given platform offers 200 different cryptos, am I comfortable with that risk profile from a regulatory perspective? And sitting on top of that, of course, is sort of the volatility associated with the markets. So a given advisor, a given entity has to ask itself, are these cryptocurrencies appropriate for anyone, given sort of regulatory uncertainty? I'm not suggesting that none of them are. I'm just saying that that's sort of the analysis you have to go through on a given crypto. And then in particular, is given the risk profile, is this cryptocurrency appropriate for a particular customer?
What's interesting in my head, or what we just heard, was the promise of new technology with the realities of building a compliance program and thinking through risk. Right? They're not mutually exclusive. We could be excited about the technology and the promise that it holds, but on a day-to-day basis, compliance folks, risk folks, legal advisors go back and think about what those risks are, what they need to think about, and how this evolves. So I think there's we can think about both of those things at the same time and push forward with this new technology, but also think through some of the risks and things that we need to think about as compliance people and folks that think about risk.
Yeah, I think that's a really good way of looking at it, because as Esteban was talking about, the technology brings a whole bunch of benefits that lower many kinds of risk, but many of the traditional functions that we have to do, dealing with regulators, whether it's AML and sanction screening and a lot of these kinds of areas, the blockchains give us tools like TRM is way better than anything in the in the traditional world for working on some of these areas. However, the blockchain itself is missing by design some of the features that we're used to from the traditional industry, such as names on the accounts, like who is it that's trading this. We can see what an account is and what it's doing, but we don't know who that is. And there are, and this is really where it starts becoming tricky when you're trying to comply with existing regulation. I think in general, whether it's AML or securities or other kinds of regulation, a lot of it is just finding out ways of like, how do we apply existing regulation to this new technology? And sometimes regulators are actually pretty good at helping us out, and in sometimes they are still trying to figure it out themselves. And that's these cases where we don't necessarily have as much clarity as possible. But I think one of the big problems is that we're coming in, both the regulation and the way that we manage risk traditionally, we have to somewhat fundamentally change the way we do this. And then the end result will be much better than what we had before. And when I say change it fundamentally, there's still some of these more traditional tasks from the traditional financial system that has to be done. So, for example, the travel rule is not just a crypto; it's a tradition. It's something from the traditional. You have to figure out how do you actually do that in the context of public blockchains.
And just to add one more thing, I think from a process perspective, building the compliance program, building the surveillance program is largely the same in the blockchain space as it is in the traditional space, which is you start with defining what the risks are, right? That process is the same. The risks may be different, but the process should be the same. It's no different from deciding if you're a brokerage firm or an advisor in the security space. I'm comfortable offering treasuries to my customers. I might not be comfortable, given the client base, offering them inverse ETFs or leveraged ETFs or something along those lines. That I think process is the same in crypto.
I wonder if we've even crossed past that a little bit at this point, right? It's kind of hard to be looking at your large list of clients who want to participate in the space and say, we're not going to offer it, right? I think most people now are somewhere along the continuum where they're like, how are we going to do this? Let's dip our toe in. I'm sure everyone here is getting the phone call. We want to do this. Tell us what we need to do. What are all the touch points that we need to consider? Because we need to get there. This is in the space of being an eventuality or an existing reality versus we're not going to touch it. We're hearing that less and less. I don't know about the others, but in my head, that's what we're hearing.
Crypto is a magic wand that turns normal companies into financial institutions. It like fundamentally democratizes the creation of financial products and also, you know, what you can create with finance. So we are seeing like the banks, fintechs, the payment companies knocking on our door and saying, hey, how do we manage AML risk and maintain the same compliance standards that we've always had while, you know, opening up crypto related services. But what's surprising and exciting is you've got gaming companies and consumer good companies that are, you know, looking to launch NFTs and auction houses. You've got a really wide range of companies that, you know, you might not have thought as having compliance teams in the past that are now looking at, okay, you know, if I'm moving value digitally, I need to start thinking about you know, anti-money laundering and other controls.
Then what are some of the major pain points that still exist for market participants and prospective companies or people who want to join into this space? Pelle, if you want to start there.
Yeah, so our company works with mostly crypto exchanges trying to implement the travel rule. And one of the aspects with that, so this is existing companies in the crypto space, but there's also a lot of new companies entering the space that are reaching out to us as well. But one of the big issues that they're facing implementing the travel rule is that public blockchains were not really designed to do this. And again, they shouldn't be designed to do this either. So there's a lot of urgency about implementing it. A lot of companies don't yet understand why they have to do it, but there is a growing understanding of this. So we've been doing surveys and we just published a study today called The State of the Travel Rule. And within this, I mean, we're seeing some really great numbers that 67% of the respondents, for example, they plan to be fully compliant with the travel rule by Q2. And close to 1/3 are already fully or partially compliant with the travel rule, which is also what we see just within our customer base. But the interesting thing is, of the companies that are trying to get live with this in Q2, there's a lot of legal uncertainty. There's a lot of operational issues here. And in many cases, they haven't yet started to do more than just research on it. And some of the issues that they're talking about is that there's a lot of, like, they need more help from the regulators in many cases. There also needs to be more open conversations between industry members on how to do this. So it's a really good example of a particular compliance case where certain regulators around the world have actually been very active at working with their regulated companies in doing this. And we've also been helping facilitate test nets, bringing regulators in this, facilitate conversations with this. This is a similar approach that could be used in many other compliance areas. So within the AML space, we do have FATF, so an international organization who's trying to push, you know, good guidelines about this globally, which, you know, for some is a blessing or a curse, but I actually think it's good because as we're an international industry, we need to think about these kinds of things globally. And I don't think there's anything equivalent. I may be wrong because this is not my subject area, but like on the security side, I think everything's very nationally focused, which also causes a lot of complications there.
Yeah, it's as a crossover to other components of the compliance spectrum. And Matt sort of brought this up earlier. While there is regulatory uncertainty, compliance people and legal advisors have to still operate, and they have to think about what regulators are going to be thinking about in their enforcement cases and where they're going a few years down the road. And we need to think about that today. I'm reminded of a story. I think I've told this once or twice. When I first started here at Eventus, I talked to some of our CCO clients and asked, where do you start faced with so much uncertainty? And the answer I got was, which I agreed with, you start with first principles. Know your risk, come up with a plan to cover that risk, and then execute that plan. And what we're seeing is very much a maturing process. So whether there's an international body that's thinking through these in many working groups, or you're thinking about this on a national level or even a local level, I think that we're watching the maturity of the legal and compliance community in this space. We're seeing a ton of traditional finance people come racing into this exciting new technology for a number of reasons. One of those is because it's exciting and new. And the other reason would be because they're needed, right? The folks that come from traditional finance kind of wear the battle scars of the past. And those are really good lessons to bring to the table in this maturing process. I'm sure at some point people might, bring up regulation by enforcement, but I'll give that a pause for a second. I assume Matt and Esteban might have a comment on this.
Yeah, I think there's a couple pain points that we see. One is identifying what the right portfolio of risk management controls are for the crypto related use cases that you would like to enable, and the second is that crypto is moving faster than anything we've seen in our lifetimes. And so those controls and the technologies you may need, may change over time. So in the first bucket, embracing crypto means a lot of different things. There's a kind of a life cycle that we see with financial institutions when we help advise how to go about moving through those different stages. In the early days, it might just be, hey, we want to enable crypto as an asset class to our customers, and we don't want to touch crypto, but we want to partner with custodians and sub-custodians to do that. And there's established playbooks on how you can use know your VASP solutions, for instance, that'll enable you to have risk profiles on various custodians and sub-custodians so that you can essentially partner with them. Then you move on to, okay, well, I actually want to start transacting on the blockchain ourselves. We're going to custody our own crypto, and we're going to execute transactions on behalf of our customers. And there's transaction monitoring solutions and wallet screening solutions that allow you to do that in a compliant and safe way. And finally, on the other side of the spectrum, you have folks that want to issue their own assets and create tokenized securities or NFTs or other things. And there's tools and technologies that allow you to understand risk cross-chain in this multi-chain world that we're operating in. So that's the first thing. It's figuring out what is the right kind of portfolio of tools that I'm going to use to manage risk. Whether it's market surveillance like Eventus, travel rule solution like Notabene, a transaction monitoring solution from TRM, and packaging these together into a holistic risk management platform. I think the second thing is the risks are evolving every day. 4 years ago, it was mostly Bitcoin and Ethereum, and so the clients that would be coming to your platform, those are the assets that they're dealing with. But today, we live in a multi-chain world, and threat actors are not only using sophisticated money laundering techniques within blockchains, but they're moving funds across blockchains. And we've seen even instances where sanctions-related funds have moved from one blockchain to another. And so, with technologies like cross-chain analytics, you are able to manage those risks, but it is a new environment to be operating in, where compliance teams are having to constantly educate themselves about what are the trends in the technologies and how do I mitigate risks to these emerging typologies.
Yeah, it's a great point. We're seeing very similar things on the trade surveillance side. We get lots of questions across asset classes within the crypto world, between the crypto world and the non-crypto world. And we're also seeing the evolution of known surveillances and asking questions like, well, I'm issuing tokens and I have folks who can trade in this space, how do I worry about insider dealing? There are all kinds of interesting touch points that are happening as this evolves and as the compliance teams evolve. And I think that's another sort of pain point to consider in this, that part of things is maturing too. There's a level of understanding of this market that's growing as TradFi people come into the space, and they're learning the technology, they're learning the lingo. There's a whole set of vocabulary that comes with things. And like any new technology, it's not always easy at first to think through those things. And discussions like this and the many that occur in the marketplace are really instrumental to helping those folks out in the maturing process. So I think that's another pain point. We're all learning and evolving with this process.
Yeah, I think. I'm sorry, I was just going to say I think the maturation point is a good one. There now are a lot of tools, as everybody's saying. You start with onboarding in terms of just being able to onboard customers, clients, et cetera, to, if you're a crypto entity of some sort, there are obviously lots and lots of ways now to do proper KYC AML checks. There are a number of risk management tools, trade surveillance tools, things of that nature now. There are a number of data providers, that will provide data to either to retail investors, but also to market makers and other institutional investors who are interested in trading in the space. And those have gotten much, much more sophisticated. And they're not only sort of what I would think of as more sort of traditional data, but there's been an evolution of data to incorporate like social media sentiment and things like that in the crypto space that really don't exist in the traditional finance space. So all of that is interesting and exciting. I think that there's an one of the pain points is educational, particularly with respect to the regulators, right? I just discussed all of these tools that are available to a variety of market participants. I'm not sure that the regulators fully understand that those tools are available and what they do. They're keenly aware of market fragmentation in the crypto industry, both on a national and sort of global basis. But I'm not sure that they understand that there's been a lot of work done to sort of help deal with that fragmentation through things like data products and through traditional market making, arbitraging markets, things of that nature. The other pain point, I think, to the point that Esteban was making was it's a fast moving space and products are developing all the time. And as a lawyer dealing with legal and regulatory issues, the sort of regulatory risk profile of trading a cryptocurrency, a token native to a blockchain is much different from the regulatory exposure related to some sort of DeFi product. And those DeFi products are very different across the DeFi product spectrum. Some of them don't look particularly problematic from a securities law perspective. Some of them look clearly like there's some sort of security-based swap or something like that. That's a different risk profile from staking. And even within staking, there are different types of approaches to staking and how retail and institutional investors may be offered access to that. So those sorts of the fast-moving, inventive nature of the space right now is fantastic, but it creates a lot of difficulties from sort of a legal regulatory evaluation perspective. And if the regulators are still sort of trying to get their heads around the legal and regulatory status of Tezos, or I don't mean to pick on Tezos, but just as an example, how are they getting their heads around a DeFi product?
Yeah, going off of that, how do you think both compliance standards and regulatory officials across the globe can adapt to these fast changing environments and what they focus on in both the short term and the long term? Is there a way that crypto focused companies and regulators can work together to share a vision over time?
Yeah, I think it's really important that both sides are open to talk, and I think this is something that's been problematic in the industry. I mean, I've been in the crypto industry since the very beginning, and there's definitely a history of we're not gonna comply with anything. You know, this is decentralized, et cetera, and that still continues on today. This attitude, and I do understand, you know, where that attitude comes from. However, we need to kind of figure out how do we differentiate between what we do as businesses with this technology and how we work with regulators on these fronts. And I think one of the big problems is that from the industry, because we don't, you know, there's this culture of not wanting to comply. We kind of nitpick a little bit when we look at the requirements. Oh, this isn't covered because it doesn't specifically mention crypto or some of these kinds. And we have to be a little bit more open to go back to first principles, as you know, as we talked about before. And then at the same time, regulators should be more open to talk with the industry. And some regulators are, I have to say, you know, a lot of regulators get a really, people really don't appreciate how much many regulators are actually willing to learn and willing to do this. There's also one of these kind of things when we talk about lack of regulatory certainty, where we are in this industry, we also need to be careful about that. How much regulatory certainty do we actually want on this as we're still developing and learning from these kinds of things? And this is why, you know, when we're working with different regulators, figure out where are we now, but in a way that doesn't just fix ourselves into the cryptocurrency version of fax machines or something like that, because we are definitely at risk of that if we ask for too many guidelines. Then those guidelines will be fixed at a point of time, and this is one of the blessings, but also the real hard things dealing, like in the US, for example, that the US regulators tend to not want to be too specific on how to do these kinds of things. And we're asking for this, but I think it's up to both sides to have a dialogue about this. And regulators are, of course, need to be better in many cases at talking with this, but we also have to be better at this in industry, suggest solutions to this, go back to first principles ourselves.
Yeah, I think it's a fair point to say, and let's say regulators and legislators, right? It's a fair point to say that it takes time to pass new legislation, think about what thoughtful legislation would be, and then figuring out the regulatory guidelines around those other things. We just have to look at, you know, the history of major market regulation to understand that that's a true statement. It takes time to think about what's right, to talk through it. There are lots of voices that want to go in various directions. I was sort of surprised a few months back. I was talking with someone in this industry, and they were saying, "Hey, I did my homework. I studied what the regulations are. I'm operating my business within the context of existing regulations, and I'm doing okay." And then you have others, as you suggest, Pelle, that are, you know, on an opposite side of the spectrum. But I think, you know, 2 points here. We definitely have a growing group of larger entities who are very mindful about how they're building out their, how they're being thoughtful in building out their legal and compliance teams, and how they're approaching a regulatory framework and regulators. I think that needs to be, that was on display, I think, in the hearings that we saw late last year. And I think legislators are being thoughtful here too. We're seeing lots of discussions, good discussions around understanding the space, what's needed, how it could operate while protecting market integrity and investors generally. All of that seems to be moving in a direction, but it just takes time. And at some point, we think about, as compliance folks, okay, while that's all taking time, what do I need to do right now? And you know, we've talked about some of that already.
Yeah, I think to follow onto that, you know, there's like this 2-track dance that's taking place right now. There's like, on one hand, it's how do we take the existing regulatory frameworks, you know, that we know well, and how do we apply them to crypto? And we've been inspired by these other set of conversations we're seeing with regulators, which is, hey, look, a lot of the assumptions are different now, and what crypto native risk management frameworks do we need to design and create moving forward? And this is going to take a decade to play out. We're going to see a lot of application of existing frameworks, and we've got clear guidance from the international level with FATA for supervisory agencies, from MAS in Singapore to the FCA to FinCEN in the US have put out clear guidances in terms of how the existing regulatory frameworks apply to crypto-related businesses today. But we're also seeing conversations about what has changed in the assumptions. Like in the US, the Bank Secrecy Act is based on this assumption, right, that financial activity happens through financial intermediaries, and that there's only a set number of financial intermediaries. But crypto breaks a lot of these assumptions. We have decentralized exchange technology, and because now anyone can create a decentralized exchange interface from their basement as a 16-year-old and sophomore in high school, we have to rethink just the sheer number of financial intermediaries that will exist, either as centralized institutions or as software. And so we've been really inspired by some of the conversations that we're seeing in terms of, well, how could decentralized identity impact kind of data collection requirements and reporting requirements and maybe promote greater financial privacy. So I think we're excited to see both of these tracks continue to evolve, more clarity in terms of how do existing frameworks apply, but also how can we design native risk management frameworks for crypto.
Yeah, I mean, I think all of those are good points, and I agree that there may be something to the idea that there can be too much regulatory certainty, right? You get boxed in. I think regulators have a habit, and it's not really entirely their fault, of designing regulations for the past as opposed to the future, and we need some sort of principles-based regulation. I think the other thing to keep in mind, the regulators are rightfully concerned about investors, right? I mean, the worst thing that in the mind of the regulators that can happen in the markets is investors are getting ripped off, and that can occur in a lot of different ways. It can be out and out fraud. It could be poor capitalization of an entity that's involved in the securities, not the securities, but just the financial transactions world. It can be poor cybersecurity. It can be poor, custody of assets. All of those things are legitimate concerns and are, sort of swirling around, I know, in the back of the minds of the regulators. So I think that's important. And I think in terms of innovation, it is going to take regulatory innovation. It is going to take effort on the part of some industry participants. So let's talk about DeFi for a second. DeFi is a very broad term, right? It covers a lot of different types of products. But I could imagine somebody who has a particular DeFi product that they've looked at, that they think is a great product, and they're pretty sure that it's a security or raises concerns under the securities laws. And this is that's not a new concept. I mean, there are products that have evolved over time that are not specifically identified under the existing regulatory framework, and there's a way to deal with that, and that's to go to the SEC staff and get a no action letter. That's been a tough process so far in the crypto space, but all it takes is one or two entities to go to the SEC, get a no action letter. It's going to take some time to negotiate that it will allow them to launch their DeFi product in a way that's consistent with the securities laws. And that to your point about this being a 10-year process, I think that's right. And I think it's going to be new regulations from various regulators. It's going to be the legislators, and it's going to be the industry itself pushing where it needs to push and getting regulatory blessings where it can.
I just want to make a quick note that in about 10 minutes, we're going to move to Q&A. So if participants would like to add questions to the Q&A section, we have a couple already coming in. That would be great. But in the meantime, for our panelists, another question I had for you is kind of what is the playbook moving forward? What is that going to look like?
Well, I'll take it from a compliance perspective and a surveillance perspective. Maybe narrow that down a little bit, and then we can broaden it out. You know, when we start talking about, we've been talking a bunch about first principles for this community to think through its level of risk to the market, and I think for each of our respective companies here, the answer is slightly different. I think when we think about trade surveillance and transaction monitoring, I think there are 4 things in the playbook that people will be thinking about going forward, and they relate to the technology that people are using, the tools that they're using to surveil, their process, their compliance program, and then the kind of guidance that they're getting. So they'll be, I think, very focused on these things as it relates to the technology, learning it, understanding it, bringing it into the fold. What tools are they using? I mean, that's why our companies represented here are talking through how some of our joint clients are thinking through, or clients that we hum in are thinking through, how do we take information from one vertical and bring it to the other and look at it all together in a single pane of glass. I think this is a growing part of the playbook. And just to pause there for a second, when we think about the challenges for compliance folks, something new in this space is the fact that they're all thinking about KYC, AML, transaction monitoring, and trade surveillance, and related items like the travel rule and that kind. They're all in one breath, right? Historically, those have been very separate groups. I grew up on a trading desk. I never knew the AML people because I was focused on trade surveillance and that activity. But that the blockchain and this activity has changed that equation, and compliance folks are thinking across the board. So all those verticals. So it affects the process on how they build their compliance program. You hear lots of terminology like flexibility, interoperability. These are not just words we're throwing around as sales items. They're actual things that people are thinking about, how each function talks to each other. And then lastly, I would say in terms of the playbook, it used to be, let's say before I came to the vendor space and I was a CCO at a firm evaluating trading surveillance tools, I'd want to know the distinctions between those and asking, do you have a better mousetrap? I think today compliance folks in this new space are asking the question, what do I need to do to comply? And I'm sure, Matt, you're getting a lot of those questions. I'm sure everybody's getting those questions. Tell me what the program needs to be in certain space. So they're looking to trusted advisors who are thinking across these spectrums to help them out. So I think that's part of the playbook right now, and we'll be there for some time.
Yeah, I would just add to that. I mean, I think continued engagement with the regulators is important, along with continuing to offer new products to clients, and assessing the risk of those products. And one of the things I'm seeing sort of more in the retail space, there are you have sort of fintech type brokerage firms, right, that deal with that are very popular with retail customers, and they want to offer crypto as well. They try to do that in an integrated fashion. In other words, if I'm a retail investor who's interested in both buying ETFs and mutual funds and stocks and crypto, I can go to a single app. And I can, through that app, I can buy and sell crypto and securities, but they're actually happening on 2 different rails, and they have 2 different risk profiles, right? The securities transactions are happening through an SEC registered broker-dealer that's a FINRA member. It's subject to the full panoply of the securities laws. The cryptocurrency aspect of that is going to be actually through a separate legal entity that, to the extent it needs to register, it's going to have money transmitter licenses, those sorts of things. You know, it's going to register with FinCEN and have the proper registrations there. So there are two different rails, and it has to be clear that to the end customer that they're dealing with two different entities that have sort of different regulatory risk profiles. But what's happening in the space when a fintech is building out that type of platform, they're collaborating with FINRA, for example. They're having discussions and telling them exactly what they're doing. The fact, you know, assuring them that, for example, that, you know, all the crypto transactions will happen through this separate entity. It'll be very clear. If I hit buy, you know, buy crypto, I'm going to get a pop-up that says, we're taking you to, you know, the crypto dealer, well, which is not an SEC registered broker dealer or something like that. There'll be a, so lots of disclosure to the end investors, lots of disclosure to the regulators. And back to the point I was making earlier, you know, the entities that are doing that, the fintechs that are doing that, they're building out compliance programs for the crypto side too, for the broker dealer. You know, they have, or the crypto dealer, they have AML, KYC. They're monitoring transactions. They're thinking about what products to offer to their customers and not offer to their customers. So I think that's what we're going to continue to see, an evolution of those types of models.
Yeah, in terms of kind of the playbook, I think the first step is, you know, identifying what crypto use cases, you know, your institution would like to do, and then the second step is to work with Matt. There's firms like Matt's that have looked closely at kind of the entire gamut of space and understand like exactly what you're going to need across each of the buckets. When it comes to AML, CFT. And sanctions, that's really our specialty. And so we help firms kind of think through, okay, what specifically am I going to need? You know, am I going to need just like entity due diligence for my crypto partners? Am I going to need transaction monitoring so I can detect chain hopping and cross-chain risk? You know, am I going to need, you know, something broader to manage risk across a DeFi protocol or a new stable coin or something like that? Yeah, I think it's like what are you offering? Get your orientation from these firms that have been thinking about this problem for a really long time and are really plugged in with the changing regulatory winds. And then you know, firms like TRM or others can kind of point you in the right direction in terms of what are the different configurations that we've seen and what are some of the best practices. One thing I'll mention is that we do have, you know, an academy basically that helps organizations go from 0 to 1 on, you know, what is crypto compliance and what are some of the best practices. Self-service, you know, online courses. So if that's something that's valuable, you can always follow up with me offline.
Yeah, I agree with a lot of these statements as well. Like, so when it comes to you know, traditional financial institutions, particularly we're seeing a lot with banks coming in wanting to offer products and services on top of crypto. I think one of the hardest things, but at least in the travel rule space that we're seeing, is that there's an expectation of everyone in the industry is already complying, and we can just plug into an existing well understood problem. But as so many other things in the industry, you know, we're building these systems right now. There isn't really, you know, a 10-year-old framework for you to build into this. And there has to be some patience from financial institutions around this. But things are moving very, very quickly. And the same also with, I think, to more traditional crypto companies. I think it's really important to start looking into compliance from a product and business point of view as well, because it's not just about trying to comply with these different things. You could actually, there's a lot of different ways you can actually help your customers, you know, build better products using these kinds of tools. It's not necessarily always things that have to be done in the back room. You can build safer products for your customers and then also for yourself, and then, you know, be compliant at the same time. Don't be scared of all of these things. The playbooks are being built at the moment, but you can be part of building them in some cases. And for certain aspects, the playbooks are already there. And for those who are looking to do travel rule as well, please look at our state of the travel rule report that I mentioned before on the notabene.id website as well, where you can learn a lot about the challenges and opportunities with this within that specific area as well.
Great. I wanted to move on to the questions from our participants. The first one that I wanted to know, it was actually two questions from two separate people, but I think they're similar. It was, what is the first step to start complying with regulators with a new product, whether it be decentralized finance? And also, will things like NFT marketplaces or other decentralized protocols eventually need to be compliant?
I'll give you my initial thoughts on that, and others should weigh in. I think the first step in having a compliant product is analyzing that product, looking at it and thinking about what does it do, to whom are we going to offer it, and what potential regulatory issues does it raise? Does it look like if we apply the securities framework to it, does it look like a security? Does it look like some sort of future? Does it look like a banking product? Something along those lines. That's the first step. And then I think the second step is really doing a risk analysis at that point, which is, well, look, it has these aspects to it that might be sort of securities-like, but not exactly. And part of that is applying something like the SEC's Howey framework that they put out, where they sort of give multiple criteria for evaluating what is or is not a security. That's really the first step. If back to the idea of sort of regulatory engagement, depending on that risk profile, the company or entity may decide to engage with regulators at that point and see what sort of feedback they can get or what a path forward may be. With NFTs in particular, I mean, it's a really dynamic space, right? It depends on the nature of the NFT, but most NFTs, I think, on their face look like maybe some sort of commodity, intellectual property. Probably most of them are not securities, but I think where it gets complicated is if you have entities that want to buy and sell securities, and they start doing things like selling interest in NFTs and things of that nature, where they're pooling assets to buy NFTs, or they're slicing NFTs up into component parts, and that starts to look like it's some sort of securitization. And there are, I think, probably some questions around NFTs that have sort of residual payments attached to them. If do those residual payments that sort of stay with the life of the product, the life of the NFT, create any considerations under the various financial services laws?
Yeah, I would just add one comment, other than if you're starting something new, call Matt, because he'll help you. In larger part, the answer is understand who you're getting guidance from, and seek that guidance out. I've talked to a number of folks who've described to me some things that they're doing, and in the DeFi space, and I kind of suggested, have you heard about insider dealing, or have you heard about spoofing and layering and manipulation and those kind? Not to suggest that they were doing those things, but the point is that there is a sense that this is so new that existing rules about market manipulation, disclosure, and all these kinds of things don't apply, and that would be inaccurate. So I would suggest understand who you're getting guidance from and go seek out the right kind of guidance generally.
Join industry groups as well. There are a lot of industry groups right now that are working on these issues. I always like, just as an exercise, and you don't necessarily have to verbalize this exercise, but like within your team, also, again, we talked about this before, go back to first principles a little bit, so yes, and an NFT, for example, FATF, they said, well, you don't have to, an NFT isn't a virtual asset, except when it is, right? And this is like what, and then you have to look at what does that exception mean. So if you're just issuing NFTs literally as collectibles, it probably isn't. But then at which point does it actually become an asset? And in that particular point, is there a point when it's also security, as we talked about? So think through some of these kinds of things, and don't get too focused on the wording of it and the tech. Try to think through, and with this, then you can start ideating when you're building completely new products on what is this? Is there some way? Is my smart contract doing money transmission? And if my smart contract is doing money transmission, how am I making sure that it's not doing money transmission on behalf of me, as with me as the intermediary being the developer? Think through these kinds of things. And I think very few people, they do these first principles because they just look at, oh, there's no mention of this and that in the particular law, but think through it. And through that, and that doesn't mean you necessarily have to start changing things straight away, but doing this yourself, then you can talk way more intelligently with advisors and industry groups and those kinds of places, venues as well. And I think regulators actually also, in my understanding, if you go in and actually talk through these, many regulators, again, not all regulators, but many regulators actually really invite people coming with some of these fundamental questions.
Cool. And then another question we got is that one of the participants said, it seems that the biggest issue is the gray areas between crypto and traditional finance. What are those gray areas to you guys, and how should that be addressed?
I don't know if there's a lot of a gray area necessarily between them. It's just that they're very different. So the gray area is more, you have to start dealing with things differently, or start using tools like Eventus to combine different data sources to look across these kinds of things. But I don't know if there is directly a gray area between there. It's just that they're very different, different kinds of technologies, and sometimes there's a clash in there.
Yeah,
I would. Sorry,
go ahead, Matt.
Go ahead, Joe.
No, you go, Matt. All right. I think there's one area, and you sort of mentioned that that relates to data sources. The data is different. There's a lot of it. It's coming from a lot of different places, particularly in, let's call it the CFI space. The larger digital asset venues are doing surveillance of a lot of this disparate data in real time. So there are technology challenges, and I believe that's true for the travel rule space. I believe that's true for the the blockchain space that TRM lives in. So that there are data issues that relate to identity, the amount, where it's coming from, privacy, cybersecurity, that causes people to feel like there are gray areas for sure, because we've kind of, it's not perfect, but in traditional spaces, we've honed these issues over time, right? We've talked about various ways data is stored. There are very specific ways people think through these issues, and they're well honed. But all of this is new in this space because of the technology. So there's gray area, I would say, particularly around data, how it's stored, how it's surveilled, how it's shared, those kinds of things.
Yeah, I mean, I think there are regulatory gray areas that we've already touched on, right? Which are, what is this particular asset, and how was it issued, how was it created, et cetera. Those sorts of questions are the difficult ones for regulators and for the entities who are involved in the crypto space. Again, products like DeFi, or a product like staking. Staking, I think to a lot of people just simply looks like providing a service for a fee, right? You're supporting the consensus mechanism of a blockchain. But how that's done matters to the regulators, and that's where I think we get into the gray areas. Likewise, somebody may issue a token it could be a utility token, it could be a token that's native to a given blockchain, something along those lines. Its function is, again, to allow access to that particular service, that particular blockchain, et cetera, and it has a specific use case, but how it was created, distributed, financed, et cetera, matters to the regulators. So those are, I think, where the regulatory gray areas arise.
Great. And we have about 5 minutes left, or 4. I want to be conscious of everyone's time, but one more question from participants was, what are the panelists' views on yield-bearing accounts and supervisory actions against Celsius, BlockFi, et cetera? Should those accounts be classified as securities as the SEC, and should certain US states have that asserted?
Yeah, I mean, I'm not going to comment on the specific entities, but this gets back to DeFi products and other similar types of products. And what I would say is structure matters, right? It's one. If a person owns a cryptocurrency and wants to lend that out for some use in return for a payment, that is different from something similar where, rather than having owned the cryptocurrency in the first instance, some entity is offering a person the ability to pay fiat currency, and then that entity is taking that fiat currency and doing something with it, like then turning around and buying cryptocurrency and lending it out, et cetera. That seems like a subtle distinction, but that makes a huge difference to the regulators. The latter thing that I described, where I pay crypto to somebody, I pay fiat to somebody, they take my fiat and they do something with it and pay me yield, looks a lot like a security to the regulators, right? Because I've paid a third party for a return. And depending on, and if there are guaranteed yields and things of that nature, it could be a banking product too. So the bottom line is structure matters, and that's I think the most important consideration in that space.
Joe or Esteban, do you have any thoughts on this?
No, good.
Okay, well, great. We have about 2 minutes left. So is there anything else that any of you would like to add that we haven't discussed already that you think is like a really important, noteworthy thing to drive home? Just kind of opening up the floor.
I think there's, Pelle sort of suggested it, and I think it's worth mentioning. There's a community of associations out there that are working really hard to bring people together and talk about these issues. I'm not going to list them out, but they're out there. Reach out to us. We'll introduce you to them. Folks are spending a lot of good time understanding the various angles of the business, the various angles of regulatory uncertainty and how to deal with it. And there's a lot of good discussion happening in this space. And I think the other thing that's worth mentioning is that there are plenty of very thoughtful legal and compliance officers out there working really hard to build great compliance programs that are relevant for their businesses to help grow this industry. And I think it's worth a bit of recognition for that group. Many of the great ideas that we get as business and as vendors, and I'm sure this is true for Pelle and Esteban, come from our clients. And we try to be as flexible as we can to work with them to build products that are fit to purpose, that make sense to them, that maximize their resources. So this is a great dialogue, and we should continue that amongst our collective clients and with the associations and with the various advisors out there that are trying to help people out.
Great. Well, that concludes our time. So I just want to wrap it up and say thank you to all of our panelists and attendees for joining us. And again, a big thanks to Eventus for sponsoring this event. I hope you all enjoy the rest of your day.
Thanks so much.
Thank you.
Thanks, everyone.